So this is what, can make a stock a potentially great profit opportunity. It's that volatility that can normally double, and in some cases even be more extreme than that. So this is what we want to look for, and this is the potential opportunities that you're going to be able to get. So here's just kind of an example. So here's NVIDIA, and look at this example back when it was trading at $270. That's amazing, huh? So, on the 13th of February, so on a Thursday, they were going to have their earnings release after the close. And so one day at expiration, so the next day, the 14th, was going to be the expiration date. So it was trading going into the earnings on the 13th at $270. Now you can see here the implied volatility. So right here, this series here, this is the 14 Feb series, one day at expiration, and you can see the implied volatility of this series is over 114%. Now you can look behind it, you can see, the normal volatility for NVIDIA was, around 40%. So you can see, it's doubled, it's almost tripled, right here, or over triple as far as the implied volatility moving up. So normally it's around 40, now it's 114. And that's going in just one day to expiration. So that's all the uncertainty that's building up. So the market's saying it could go potentially, theoretically, it could go up $17 or it could go down $17 the next day. And that would just be a one standard deviation move. But as we see in earnings, a lot of times we can have greater moves in one standard deviation. It could be two or sometimes even greater than that. So here's kind of the normal move would be here up 17 or down 17 one day later. All right, so that would be the normal implied move. All right, so but sometimes can be a lot greater, but that's what we can potentially take advantage of to, if you're looking to sell the implied volatility when it spikes higher, or sometimes we might even want to play the price spike. So I'm going to show you some different strategies that you can use to kind of take advantage of this high implied volatility or the potential big spikes. All right, so that's it going into the earnings release. And then you can see the day after the earnings release, you can see that volatility is crushed, it's collapsed. And so it's gone kind of back to normal. So it went from 114 the day before, now it collapsed back down to kind of the normal implied volatility down to 35. And the price though also spiked. You can see this price now was up 7.5% up to 291. So you have these kind of different things that can happen. You can have the big price spikes, you can have the implied volatility collapse. So you have a number of different ways to take advantage of an earnings trade going into its earnings and then even after. All right, so you can see here on the chart, here it was trading right there going in at about 270. The implied volatility, you can see below, this kind of graph below shows you how that implied volatility kept moving higher and higher as it approached earnings and then collapses after. That uncertainty is taken out, and it's like popping a balloon. So it's trading right here going in, price spike up, 7.5%, implied volatility collapse. So a couple things, to way to play that trade. And so that's what we'll talk about here in a couple minutes. But that's kind of, what you're going to see in a lot of these different individual stocks.